Friends, welcoming you all for this fourth session on ratio analysis. In this session, we will discuss mainly the financial ratios. Financial ratios are also basically called as solvency ratio. Now, getting into the topic, solvency ratios are basically classified into two. One is long-term solvency ratio and the other one is short-term solvency ratio. So what are all the ratios to be covered in long-term and short-term are given here. Basically, fixed asset ratio, debt equity ratio, proprietary ratio under long-term solvency, and current ratio, liquidity ratio, super quick ratio, defense internal ratio under short-term solvency ratios. We will see each and every ratio with an example. Okay, number one. First, we are going to see fixed asset ratio. So, for facilitating understanding of this ratio, before getting into theoretical part, we will see a case. See, you are given a balance sheet here. This balance sheet has got, say, only the fixed assets. There is a gross block of 110 rupees and there is a depreciation of 10 rupees. So, the net block is 100 rupees on the asset side. And on the liability side, if you notice, there is a share capital of 20 rupees, reserves and surplus of 10 rupees, and term loan of 70 rupees. So, from this balance sheet, what you can infer is there is a asset of 100 rupees, there is a fixed asset of 100 rupees, and that fixed asset has been funded through shareholder funds of 30 rupees, that is equity share capital of 20 and reserves and surplus of 10. So it has been funded 30 rupees by shareholder funds and 70 rupees by outsiders funds. So here, from this balance sheet, what we can understand is this 100 rupees funded by two parties. One is equity shareholder funds, the other one is outsider funds, which is in the form of term loan. So 30 and 70. 30 and 70. Okay. But uh, if you notice, both these funds are in form of what? In long-term funds. Term loan is something which is repayable after a period of say 1 year or after a period of 3 years or after a period of 5 years depending upon the sanction ticket. And equity shareholder funds is the long-term fund. So if you notice, both these funds are long-term in nature. So this 100 rupees of fixed asset is funded by long-term funds of 100 rupees. So this is what we were trying to find out here. In this case, if you look at the scenario is good, there is a 100 rupees of fixed asset and it is funded by 100 rupees of long-term funds. So nothing to worry much about in case 1, but if you take case 2, here I have given net fixed assets of 100 rupees. So like previous case. But if you see, equity share capital is 10 rupees, reserves is 10 rupees, term loan is 10 rupees, and current liability is 70 rupees. So here, what is the understanding required? 100 rupees is the asset created, and out of which 10 plus 10, 20 rupees is coming from shareholders. 10 rupees is coming from long-term funds in the form of term loan, and another 70 rupees is coming from current liability. So what is the understanding required here? In this case, if you see, out of 100 rupees, this 100 rupees of asset were funded by two sources. One is long-term fund, the other one is short-term fund. In long-term fund, 20 rupees from equity shareholders and 10 rupees from term loan. And short-term funds, current liabilities, 70 rupees. So what is the risk here? See, 100 rupees fixed assets have been created. So what is fixed assets? Fixed assets are those assets which were acquired not with the intention to sell immediately. But here what they have done is they have used current liability of 70 rupees to fund this fixed asset of 100 rupees. So what is the risk here? This company will suffer liquidity problem because this current liability of 70 rupees is from basically say sundry creditors or basically say from bank cash credit. These are all called as current liabilities because these have to be paid in short period. See, the idea of calling these as current liability is they have to be paid in short period. So in this case, the 70 rupees have to be paid in short period. But what happened? The 70 rupees has got and logged in fixed asset. This fixed asset will not generate 70 rupees immediately. It is a long term asset. It will generate revenue only in longer period, in future period. So if the suppliers or bankers come and ask for repayment of the 70 rupees immediately, what will happen? This company will not be in a position to meet it. So then what will happen eventually? If the demand is not met immediately, because current liabilities probably they will be repayable on demand. If that is not met immediately, then whomsoever the suppliers or whomsoever the banker, they will they will they will enforce the securities. They will enforce the securities given for that current liabilities, and this can result in what? Standstill in operation. This can result in standstill of operation. The company's operation can come to a halt, and finally it will even end up in what? Closure of business, because this supplier, current liability suppliers or bankers, will have all right to ask for closure of business and liquidate their dues if it is not paid on time. So that is the risk involved in diverting current liabilities for creation of fixed assets, because fixed asset will not generate revenue immediately on whatever the amount spent. It will happen only over a period of years. So the idea of the ratio fixed asset, I mean the idea of fixed asset ratio is to find out whether any short term funds have been deployed for creating fixed assets. How that is calculated? In this case, you take both the cases. In case 1, the fixed asset created is 100 rupees, and what is the long term fund used for that fixed asset? It is 30 plus 70. 30 plus 70, what does it mean? 100 is funded by 100, so the ratio is 1. Fine, no issue. Take case number 2. Fixed asset created is what? Fixed asset created is 100 rupees, and how much is the long term fund used for it? The long term fund used for it is only 30. So what is the fixed asset ratio? Fixed asset ratio is calculated by net fixed asset divided by long term funds. In this case, 100 by 30, it is 3.33. So the ratio up to 1 indicates usage of long term funds fully for creating fixed assets. Ratio above 1 indicate that short term funds have also been used for funding the fixed assets. So in this case, this 3.33. In this case, this 3.33 indicates what? Usage of short-term funds, because out of 100, only 30 had come from long-term funds. So the other cases have come from short-term funds or say current liabilities. So this ratio indicates the extent the other funds were utilized in funding the fixed assets, and this ratio also indicate the financial discipline process of the company. So if the ratio is above 1, it means there is a diversion, and if the ratio is above 1, the company will get into liquidity problem, and if the ratio is below 1, it is better. Ideal is around 0.67. Okay, so this is about fixed asset ratio, and it is calculated net fixed assets by long term funds. Next, next ratio what we are going to see is debt equity ratio. See, for debt equity ratio also, before getting into theoretical part, just look at these two cases. In case 1, a balance sheet of X limited, and case 2, balance sheet of Y limited is available. If you look at case 1, it has got current asset worth 50 crore, non-current asset worth 50 crore. So total asset is 100 crore. And on the liability, equity share capital is 50 crore, reserves and surplus is 40 crore, and creditors and other liabilities are 100 crore. So what can be understood is this company has got 100 rupees or 100 crore worth of asset, out of which 90 crore has come from shareholders. 50 plus 40, 90 crore has come from shareholders, and only 10 has come from the outsiders or creditors. Okay, you take case 2, balance sheet of Y limited. This also has got current assets of 50, non-current assets of 50, that is 100 crore, and equity share capital is 10, reserves and surplus is 5, other liabilities are 85. So in this case, this company has got assets of 100 crore, but out of which equity shareholder funds are only 15, and the other financing have come from outsiders. Other financing has come from liabilities, that is around 85. So if I simply ask you which company is strong here, if I simply ask you which company is strong, then by looking at the numbers, we will be able to make a decision that company X has got net worth of 90 crore, right? It has got equity shareholder funds of 50, reserves and surplus of 40, whereas company Y has got only 15 crore of net worth, that is 10 plus 5. So which company is strong? If I ask you, you will be able to say X Limited is strong because its total net worth or tangible net worth is around 90 crore. Okay. Now, next question. Which company will be preferred by the investors or lenders? Which company will be preferred? See, in this case, both the companies has got asset worth 100 crore. But who will prefer X or Y? See, in this case, X will be preferred. X will be preferred. I'll tell you the reasons. Reason is X has got very comfortable net worth of 90 crore and its liability is only 10 crore. So even if you think on the extreme side of liquidation of the company, or the in the event if default takes place for this company, say this company is not in a position to meet 10 crore, what will happen? Net worth of 90 crore. I mean, equity shareholder funds of 90 crore is available, and this will be sufficient to take care of obligation of 10 crore. So, a lender, a investor will be interested in a company which has more net worth and less liabilities. Okay, so that is generally measured through what? Proportion of total liabilities by total net worth. This is the ratio which were used by bankers across all the sector. So the investor or banker will be more comfortable with the company which has low level of debt and high level of equity. Reason being, in the event of default, the company will be able to withstand the level of vigorness. So if say company X defaults, it will be able to manage the situation because it has already got its net worth of 90 crore. So meeting 10 crore will not be a difficulty. But if you take company Y, where things are on the other side, its net worth is 15 crore and it has got liability worth 85 crore. So whether this company will be preferred by investors or lender, the answer will be no. Reason being, it has got a liability, already it has got a liability of 85 crore. So in the event of default, the company may have to what? Liquidate. In the event of default, the company will have to liquidate its 85 crore debt, but it has got nothing except for 15 crore. So out of 85, only 15 crore can come from the net worth, and another 70 crore company has to find out some other ways, like what? The guarantees given by the directors or the personal properties given by the directors. So it is obvious company Y will have less preference and company X will have more preference because of its comfortable level of net worth. So this is what measured through this ratio called debt equity. Here we will compare the net worth of the company with the total debt of the company. So this ratio, if you say net worth is 90 and liability is 10, so the ratio will be measured as debt by equity. In this case, it will be 10 by 90. 10 by 90. So the ratio will be somewhere in the decimals. So if the ratio is below 1 or if the ratio is below 2, things are okay. Nowadays, bankers, lenders are ready to accept the ratio up to 3, but anything above 3 is not considered desirable, because above 3 means the equity shareholders participation is less than 25%. Is less than 25%. So up to 3, which denotes 25% contribution by the shareholders or owners and 75% by lenders. So up to 3:1 is preferred. Okay. So some notes are available. This ratio actually measures the fundamental strength of the company in its net worth. So in this ratio, I was saying debt. So in practice, when they say debt, they say all debts. I mean total liabilities. But for your examination purpose, debt can be either total long-term debts alone, total long-term debts alone. It depends upon the question. It depends upon the question. And this ratio indicates the margin of safety to lenders. To what extent lenders are safe? If I say the ratio is 3:1, lenders are safe to the extent of 1, that is 1 by 4, which is 25%. 25% security is available. Okay. And this ratio indicates the risk of insolvency. So if the ratio is 1:1, the risk of insolvency is very rare, because if the company defaults in meeting obligation of paying 1 rupee, then it will have what shareholder funds of 1 rupee to meet the obligation. But if the ratio is somewhere around 3:1 or say 5:1, then for meeting 5, 1 will not be sufficient. Okay, so that is what the understanding required from this ratio called debt equity. Next, we will move on to the next ratio called proprietary ratio. See, this proprietary ratio, just to understand, take this two cases, X limited and Y limited. X limited has got asset worth 100 crore, and out of it shareholder funds is 50, outsider funds is 50. Outsider funds is 50, so totally 100 crore. And Y Limited also has got assets worth 100 crore. Shareholder funds is 10, outsider funds is 90. So in this, in which company the owner has more control? If you see, in company A, out of 100, 50 is held by owners and another 50 is held by outsiders. In case Y Limited, out of 100, 10 is held by owner and 90 is held by outsider. So, in which case owner has more control? Means in case A, owner has more control because he got 50% control. In case Y, he has got 10% control. So, this ratio, the proprietary ratio, measures the proportion of owner funds to the total assets held. So, it is given by the formula proprietary ratio is equal to shareholder funds divided by total assets. That is, it shows the proportion of owner's contribution to total assets. And this ratio is also another variant of what? Debt equity ratio. See, in debt equity ratio, what we have measured is we have taken debt divided by equity. That is, we were seeing the number of times you have debt for given level of equity. Okay, but here we are seeing out of total asset what is the contribution of owner and what is the contribution of outsiders. So if 50% is the contribution of owner, then obviously 50% is the contribution made by outsiders. So that is what measured, and this ratio, if it is on the higher side, it will give more comfort for the lender, because in case X, 50% is the ratio, in case Y, 10% is the ratio. So what will happen? This 90, the outsiders, if their demands are not met in time, they will ask for closure of the company, sell the asset and meet their payment. So the lenders will not be interested in company Y, rather they'll be interested in company X, because where their promoter has more ownership on his assets. Okay. See, all these ratios are basically trying to check out that whether owners have ownership of all the assets. See, simply by being a shareholder, by holding say 10 rupees and by having 100 rupees worth of asset, just by becoming a shareholder with the 10, you are in a position to control assets worth 90, but you don't become absolute owner because you have not funded it fully. Only when you meet the entire obligation, you become the absolute owner. Till then you are managing others assets. So that's what were tried or used in all these ratios, all these long-term ratios. Okay. Next, we'll see in chapter called short-term ratios. Case 1, short-term ratio, first ratio, important ratio, we'll see current ratio. Current ratio is very important in examination point of view as well as in practical real life scenario. So to facilitate better understanding, see two cases. X Limited has got a balance sheet and its total current asset is 100 rupees, non-current asset, which means fixed assets and other non-current assets 100 rupees. So it has got assets worth 200 rupees. And the short-term funds is 150. When I say short-term funds, I mean bank borrowings, then sundry creditors, other short-term liabilities. Okay, other short-term liabilities. And long-term funds is 50 rupees. When I say long-term funds, I mean equity and term loans, if any. So, repeating, the company has got 200 crore worth of asset, out of which 150 crore is from short-term funds and 50 crore is from long-term funds. So, what should be understood from here is, since we are talking about current ratio, we'll see only from current assets and current liability angle. See, this company has got 100 crore worth of current asset. Okay, it has got 100 crore worth of current asset, and for that 100 crore worth of current asset, it can have 100 crore worth of current liability. Okay, but this has got 150 crore worth of liability. So what does it mean? See, for meeting 100 crore current asset, 100 is sufficient, but this has got 150, meaning it has got 50 extra. So that 50 plus this long-term funds of 50 have gone for funding this non-current asset of 100 crore. Okay. So, in this case, if you calculate the current ratio of the company, okay, in this case, if you calculate the current ratio of the company, it will be in a decimal position. See, what is current ratio? Current ratio by formula, if you say, it is current asset divided by current liability. In this case, current asset is equal to 100 and current liability is equal to 150. So, if you calculate, the ratio will be somewhere in decimals. Okay. So here what has happened, or the ratio going below decimal. See, if the current ratio is equal to 1, that is for 100 rupees of current asset, you have 100 rupees of current liability, means entire current assets were financed by current liabilities. Okay. So there is no question of diversion or anything. But the ratio going below 1 indicates what? Indicates utilization of short-term funds for long-term purpose. In this case, company's current asset is 100, whereas current liability is 150. So there is a 50 rupees excess current liabilities, and that had gone for what? Non-current asset. So the ratio below 1 indicates diversion of short-term funds for long-term purpose, that is non-current asset purpose. So what will happen eventually? It will result in liquidity strain. The reason, as explained, if the short-term funds, short-term creditors are not repaid on time, they will ask for repayment on demand, and if not paid, they will insist on closure of business, and they'll ask for sale of the assets and meet their obligation. So it will result even to the extent of closure of operations of the company. So that risk is measured in this ratio. Current ratio basically finds out what is the extent of company's contribution for funding current asset. In this case, if you say out of their 100 crore current asset, company has contributed absolutely nothing. Out of 100, they have taken 150, meaning 100 crore has also come from outsiders. Apart from that, they have also taken another 50 crore. That 50 crore had gone for creation of non-current asset. Okay, had gone for creation of non-current asset. So this company is likely to suffer liquidity strain, and it will even face closure of business if demands are not met on time. Okay, but you see case number 2, this company has got total current asset of 100 crore and non-current asset of 100 crore. So total assets worth 200 crore. and short-term funds is 75 crore and long-term funds is 125 crore. So total funds is also 200 crore. If you look at from current asset angle, its current asset is 100 crore, and for which it has got current liability only 25, I mean only 75 crore. For 100 crore worth of current asset, it has obligations only for 75 crore, meaning the remaining 25 crore were funded from long term funds. Okay, because this 100 crore should be funded, right? So this 100 was funded by short term funds of 75 crore plus this 25 plus this 25 of long term fund, which funds current asset. And here you will have 100 crore which will fund your non current asset. So in this case, if you look at it, their current asset is 100 and their current liability is 75. So if you take their current ratio, it will be current asset by current liability, which will be 100 by 75. I think it will be somewhere around 1.33. So this ratio shows what? This ratio shows out of 100, 75 is financed by outsiders, and out of 100, 70 is financed by outsiders, and 25 by long term funds, which is a good sign. Which is a good sign because the company is not fully dependent on outsiders for funding its current assets. See, if you are fully dependent on outsiders for funding your current asset, you are likely to run into the risk of liquidity and closure of business. In this case, only 75 is dependent on outsiders and 25 has come from own funds. Okay, so that is the understanding required for current assets. So in this case, which company is in a better position? Based on discussions, I think Y Limited is in a better position because its current ratio is 1.33. See, what does current ratio measure? The current ratio will measure extent of contribution of company for funding the current assets. See, why company should fund current assets? If the company is fully dependent on outsiders for funding the current assets or say the other assets, then the company will run into the liquidity issues. Okay. And question 3, whether current liability being more than current asset is good? Answer is absolute no. We have seen if the current liability is more than current asset, it means what? Diversion. Using short-term funds for long-term purpose. Using short-term funds for long-term purpose. So current liability being more than current asset is not a good sign. And what is the ideal current ratio preferred by stakeholders? They will prefer 1.33. You go to any banks, the norm will be 1.33. Reason being, this will ensure 25% contribution. 1.33 means 75% debt, 25% promoters contribution. And what does high current ratio indicate? Say if you have a current ratio like 2 or 3, then it indicates you have what idle resources. You have idle resources. Probably your current assets might be in the form of what? Deposits. If it is deposits, it will earn some 10% return, say. But you have all your funds locked up in current assets in the form of cash or bank balance, then it indicates you are not utilizing your resources properly. Then that actually that cash or bank balance should go as some fixed assets, and it should result in generating revenue. That should happen. So very high level of current ratio is also not desirable. Ratio somewhere between 1.33 and 1.5 is the best for any company for that matter. What does low current ratio indicates? I mean the current ratio less than 1 indicates using what? Short term funds for long term purposes. So what will be the result? If you use short term funds for long term purposes, then actually there will not be any rotation. No rotation of funds will be there. If rotation does not take place, then subsequent operations will get to a halt. Then suppliers have to be paid on time. If they are not paid on time, they will demand payment. They will insist on repayment on demand. You have to repay on demand. So if you don't repay on demand, what will happen? They will ask for selling of the securities. Okay, and if the securities are not sufficient to meet their demand, they will ask for closure of business. Okay, then business have to be closed, then their requirements have to be met. So that is the sign when if you come across low current ratio. Okay, next we'll see quick ratio. See, in current ratio, what we have seen, what is the extent of contribution of current liability and the owner's funds for building up current asset. That's what you have seen in current ratio. In quick ratio, what we'll do, just take an example. This company has got current asset worth 100 crore and non-current asset worth 100 crore. So total assets 200 crore, out of which is funded by short-term funds of 75, long-term funds of 125. So totally 200. Here in current asset, I have given an additional breakup saying inventory is 50 crore. Okay, inventory is 50 crore, or let us say inventory is 40 crore, and there is a prepaid expense. There is a prepaid expense of 10 crore, which will make out 50. Then other current assets 50, so you have 100 crore. So if I ask you to calculate current ratio, your current ratio will also be comfortable because the company has got current asset of 100 crore and short-term funds of current liabilities of 75 crore. Current ratio is comfortable at 1.33, so we need not worry much about this company. It can manage its liquidity position at a comfortable level. But I say out of their current assets, 40 is their inventory, and this inventory actually is very high for this company. For the company, for this kind of company, let us say maintaining 5 crore worth of inventory is sufficient, whereas these people are maintaining 40 crore worth of inventory. So they have 35 crore extra. So this inventory will not get converted into cash immediately. So there is no point in calling this as current asset for just analyzing purpose. And this company has also got prepaid expenses of 10 rupees. This 10 rupees is what? The expense already incurred, whereas benefit is going to be derived in future. Okay. So, I mean, for the future periods also, this was paid. So, this is also not going to be converted into cash. So, these two assets is not going to converted into cash immediately. So, I would say don't take current asset as 100. Instead, take 100 minus 40 minus 10 by 75. That is 50 by 75. So what does it indicate? Previously, you had a current assets of 100 and a liability of 75, so 1.33. But now you have a liability of 75, whereas current asset is only 50. The ratio is less than 1. So this indicates what? Out of current assets, you have taken that those assets which were not really current according to the situation. So now the company's position is not that comfortable, and this was measured when we have prepared the quick ratio. When we have prepared quick ratio, so how this quick ratio is prepared? It is prepared by excluding inventory and prepaid expenses from the current assets. Okay. So the ideal position, see if the company has ratio as 1, then its quick assets are available to meet its current liabilities. Okay, so the ideal ratio is 1, and this ratio generally throws light on overstocking. In this case, if you see their current ratio is 1.33, whereas when the quick ratio was tested, the ratio is less than 1. And why this is? It is mainly because of inventory, where the company had very high level of inventory at 40 crore, whereas the ideal is only around 5 crore. So it throws light on overstocking. And this ratio also measures short-term solvency or absolute liquidity. How it measures? The company has got liability of 75. Previously, it carried the impression it has 100 crore worth, but now it is only 50. So absolute liquidity. So previously it was thought this is the liquidity comfort. Now absolute liquidity is only 50. So that is measured through this quick ratio. Next, getting into the next ratio, super quick ratio. In super quick ratio is another modified version of what? Of current ratio. See, in quick ratio, we have excluded inventory and prepaid expenses. In super quick ratio, we will also exclude debtors and prepaid expenses. I mean, debtors is mainly excluded. So here we are basically considering only what? Only cash, bank balances, marketable security. See, this ratio is used. I mean, and we will find all these assets and we'll see whether these assets, I mean, cash, bank balance, marketable securities, are available to meet current liability. Actually, this is a very conservative ratio, and it is a vigorous test of liquidity. Okay, vigorous test of liquidity. It is not widely also used, but if a company gets one at this ratio level also, then the company has damn good liquidity. Okay. Finally, we'll see this defense interval ratio. See, this defense interval ratio basically measures the cash or liquidity support it has got in hand for meeting its what operating expenses, interest commitments, and tax commitments for the following period. Let us say the company has got operating expenses of say 100 crore and its interest commitment is around 10 crore, its tax commitment is around 5 crore. So it has got 115 crore obligation for one full year, that is for 365 days. Then for 1 year it will be, see, the company has got obligation of 115 crore for 365 days. Then for 1 day, its requirement is around 32 lakhs, say roughly around 32 lakhs. And the company on an average maintains a cash balance of, let us say, cash balance of 10 lakh, bank balance of say 50 lakh, and it has marketable securities of 50 lakh. So the company generally has 110 lakhs, 110 lakhs worth of cash on hand, and its daily expenses will be around 32 lakhs. Then the question is, how many days this company will be able to manage this situation without raising any additional funds. So if anything goes wrong, then this company will be able to manage its situation for a period of, that is around 3.4 days. It can manage its show only for a period of 3.4 days. So that is what measured through this defense interval ratio. It basically measures how many days the company can manage the show without raising any additional funds. Okay. So this is all about the solvency ratio. In this session, we have basically discussed about short-term solvency and long-term solvency ratios. Under long-term solvency, we have seen fixed asset ratio, which measures extent of contribution of long-term funds for creating fixed assets. So the ratio being below 1 is ideal. Above 1 indicates usage of short-term funds for long-term purpose, and debt equity ratio measures the strength and risk of insolvency of the company. Ratio up to 2 and now even up to 3 is considered desirable by the lenders and stakeholders. Proprietary ratio measures the proportion of shareholders funds in their total assets. And we have seen ratio short-term solvency ratios, out of which current ratio measures their liquidity, and liquid ratio or quick ratio, in that we have excluded inventory and prepaid expenses to find out their absolute liquidity. And super quick ratio also we have taken, where we will consider only cash, bank balances, marketable securities for meeting their current liability. This is a very conservative ratio. And defense interval ratio, this ratio is used for measuring how many days the company will be able to meet its operating expenses and other commitments without raising any additional funds, using its cash balance, bank balance, and marketable securities. In the next session, we will take up problems on financial ratios. Thank you.